Well, good afternoon, everyone. Welcome to this week's Mortgage Minute. My name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. Got a bright, sunny, a little bit breezy day here in the Coachella Valley, Greater Palm Springs area. We're, of course, fast approaching this week's Easter weekend. Got good hope, Good Friday tomorrow, and then, of course, the Easter holiday on Sunday. And we're on our second week with the Coachella Fest here locally, as I'm sure some of you have heard of that festival. In any event, we got a lot to talk about this week. As you know, we'd like to start with talking a little bit about the interest rate and bond market. So Jeff's going to pull up our rate grid that's present on the homepage of our website. And it's interesting because it's kind of a broken record. I mean, rates, despite all of the headlines and all the hand wringing and all this tariff talk and tariff wars and so forth, all in all, mortgage rates are hanging in there pretty well. I mean, we're still right around the mid sixes. Yes, we got down to the very low sixes here a week or two ago and got a little bit up there in the 6 5/8, 6 3/4 range here last week. But the point of it is it's still relatively stable within that range, that sort of low to high end of the sixes. That's still where we're at. And of course, we're actually in the fives for FHA, and we're just about getting back to fives on FHA and VA, just slightly above that right now. So, I think all in all, this should be somewhat reassuring to everyone that rates are remaining relatively calm or stable within all of this volatility in the financial markets. And Jeff's going to pull up the 10-year bond chart. There you see it. See, that's the kind of chart we like to see. It goes back to last Friday. This is a 5-day chart. You can see how it slopes down to down on the right side, and you can see too early in the week, or actually going back to last Friday, that 10-year bond yield was getting up there. So that's the kind of trend we want to see. What was going on in the markets this week to get us into that kind of a trend downward? Not a whole lot, actually, because in terms of the economic data point calendar, very light. We've got a holiday week. The markets are closed tomorrow, basically, so with Good Friday. So not a lot of data points this week at all. And of course, I left the bullet point from last week. More tariff uncertainty is still very much present, a lot more, as I put on there. But we'll talk a little bit more about that as to what's real and what's maybe not so real in terms of all this tariff talk. Retail sales, what did come out this week, up 1.4% in March. That's a 26-month high. So all of this financial news about a coming recession, well, the retail sales number certainly doesn't suggest that. And of course, the jobs number we had here just a week or two ago also didn't support that we're running into a recessionary period. So now what did move the market this week a little bit, particularly the stock market, was Fed Chairman Powell. He spoke this week, and it was interesting. He kind of basically put a kibosh to all of this trade strategy in terms of tariffs, suggesting instead that this is going to be likely causing higher inflation and a weaker job market, labor market. Now, of course, you put those two together, and in the economic world, we call that stagflation, a stagnant economy with rising inflation. So Chairman Powell is, of course, putting that out there as what he thinks is a likely outcome of our current administration's tariff and trade policy. Well, that's an opinion. We'll see how it plays out. But as we put at the bottom of the chart, financial markets react to stimuli with reptilian-like minds, and this is another example. He spoke through that suggestion out there. The stock market in particular, didn't like it well, and stocks sold off. So we'll see how all this plays out. But from that perspective, that frankly helped keep bond yields down, a little bit of that flow of funds as the stock market sells off. Some money goes into the bond market, and that actually helps yields. And so that's probably another part of the reason why rates have remained relatively stable throughout all of this volatility. So with that, we'll bring Jeff on. So we've got actually 3 or 4 different subjects to talk about. Hi, Jeff.
Hi, Art. Well, it has been kind of a wild time, and it just reminds me of something you've warned us about, is beware of the headlines. It's like, I saw where stocks views on financial news networks have really shot up like 40, 45, 50%, because of all the tariffs, and we're all just hanging on the edge of our seats figuring out what is really happening. And yet when I talk to my wife, who does all the shopping, I asked her, I said, have you seen any big swings in prices yet? She said absolutely not. She said actually eggs are a little bit cheaper. So I thought that was good news.
Well, that's exactly right. I mean, of course, yeah, we're suddenly in this phase where anybody who has a 401k is they're watching the market every day, because they're fretting about what's happened to the value of their retirement funds. But I don't know. I mean, everyone's different. Everyone has their tolerance for risk and volatility and all of that. But I think ultimately a lot of this is going to settle down and shake out okay. I think the problem is, yes, in the short run, these headlines can be just really unsettling. And I think in a lot of cases are a little bit off base in terms of whatever message they're conveying. And I think it can really get folks kind of unsettled beyond what they should be given what's going on.
Or it reminds me of what Warren Buffett said. He said, if you see blood in the streets, now is the time to buy. Right. And it seems like, with media, as fast as it goes now, because everybody has a telephone in their pocket that has the media in there and notifications and whatnot. Boy, it seems to me like, Art, now is the time to jump on this. Am I wrong?
No, actually, I think you're right about that, because I think this tariff environment, it's been really interesting because if you think about it, most of what is going on hasn't really happened yet. Again, it's all about the headlines in terms of the tariff war, the trade war. The headlines make you think somebody, the current administration flipped a switch and now all these tariffs are in place, and the prices of goods and services has already gone up. But in reality, that hasn't happened yet. Now there's an expectation of that, further underscored by Fed Chairman Powell himself saying, hey, I think this strategy is going to mean higher inflation and a stagnant economy. Well, okay, maybe. But what's funny about this, well, it's not funny, it's just odd, is the tariff situation really hasn't been settled yet. I mean, didn't we just get told there's a 90-day, extension on these tariffs that were announced? And now all these countries are coming to the U.S. and wanting to negotiate. Well, as that plays out, the reality is nothing really has changed in terms of tariffs, because what was going to be changed got extended for 90 days. So it's like we're running around being worried and wringing our hands about what hasn't actually happened yet. And as your wife, anecdotal evidence suggested, she's not seeing any increase in grocery prices to speak of. So why don't we calm down and let the process play out? And so what happens in terms of timing, for anybody who's been thinking about buying a house, I think this is actually creates, you don't want to time the market, as we always say, but if you've been kind of on the fence and you're getting closer to wanting to do something, this tariff situation is an opportunity. I mean, for one, if the worst case scenarios that are being predicted play out, inflation goes up. If that goes up because of tariffs, if inflation goes up because of tariffs, that's not going to be good for mortgage rates. Mortgage rates do not like inflation. That's going to push mortgage rates higher. But again, it hasn't happened yet. The most recent data was just last week. CPI and PPI were down. So with that as a backdrop, the higher inflation predicted hasn't occurred yet. And that's, I think, part of the reason why mortgage rates are remaining relatively stable in this 6% range that we've been at for quite a long time now. In fact, you can go back a year and the 10-year bond yield was similar to where we are right now today. Yeah. There was that, nice little dip for a nanosecond in last September, but other than that, it's been pretty much in that range. So the higher interest rate, higher inflation, higher interest rate prediction hasn't borne out yet. But you have to consider the what if it does, after this 90-day extension, the negotiations are completed and we got whatever we got. Will that cause mortgage rates to go up because inflation is starting to tick up? Maybe. Therefore, what is the signal to me that any prospective home buyer should hear is like, maybe we ought to buy now to protect against that possibility. And then the same thing, the other, scary headline issue related to tariffs is the cost of goods and services, and particularly building costs. Like this could contribute to the cost of building a house in terms of material, these tariff situations, however they end up playing out. So again, that could bode poorly for the future because the cost of housing could be pushed up even higher than it already is because of tariffs causing a big increase in the supply of lumber and so forth. So that's another reason that tells me is like, well, maybe to avoid that possibly happening, buy now before it happens. I mean, worst case, it doesn't happen. Things are going to be good in that environment. And if it does happen, you've already got the house, you're going to be in a lot better place.
Well, it's one of those things where now I see that, when it's like the saying, when one door closes, a window opens. And I've seen now when I talk about building materials that the president has already said, hey, we're going to start using some of our own lumber. We have plenty of forests that we can harvest and then regenerate in the future. But we have plenty of wood to build homes.
Right. Yeah, exactly right. And so I think that's the issue is that, all this is going to take time to play out. And the worst case scenarios you see in all these headlines haven't really borne out to a large degree. Mortgage rates are still okay. They haven't shot up. We haven't heard anything yet in terms of inflation starting to go back up the other way. Again, the most recent numbers last week were good, better than expected. Home builders are pretty anxious to get some inventory moving on the new home side. We're seeing more inventory of listings on the resale market side. And again, with these tariffs, to the extent you're worried about them, you can hedge your bet and protect yourself from the worst case predictions about the outcome of this tariff and trade war. Look to buy now before interest rates get any worse than they are now, and before home prices are being affected by the cost of building, from lumber and so forth. So to me, it creates a pretty good timing signal. If you've been waiting, now may be the right time.
Well, if someone's trying to buy their first home, Art, what are the 3 key things they need to know when navigating today's economic uncertainty, especially with the tariffs in play?
Well, I mean, we basically have touched on a few of those things. I mean, one, beware the headlines, ignore them. If you're trying to buy your first home, I would just say quit reading the headlines because you're getting half the time you're getting bad or worst case kind of scary information that hasn't really borne out yet. That's number one. And like I just said, understand that for right now, if you're looking to buy, I think your timing could be pretty good because rates have remained okay. And I think if we do start to get any kind of economic data points that point to softening, they'll probably actually improve a little bit. So, but in the meantime, they're pretty decent. They've been for a long time. We can help with buy down strategies and so forth to take advantage of where rates are now and get into home ownership before they do rise, if they do, depending on the tariff outcome. And then again, same thing because of the cost of building homes. The cost of building homes hasn't been directly affected yet by any of this tariff stuff. So again, you've got a timing opportunity here, which again, I don't usually, play up timing, but when you think about those 2 issues, inflation, what that does to mortgage rates, what if tariffs do raise the cost of building homes in terms of materials, then to me, you should understand all of that and, get with somebody like us, get pre-qualified now. So you're in a position to basically make an offer and strike quickly before any of these worst case predictions about the tariff trade wars actually play out. And I would take it even a step further where we not only pre-qualify you, but we would actually get you formally underwritten and approved. It's what we call in the business TBD underwriting, to be determined. So we can get your file fully packaged and in front of a lender, underwritten and formally approved by the underwriting staff with that lender, subject only to finding the property and basically getting it appraised.
What kind of a time frame typically, if people have their, I'm going to call it their ducks in order, when they come and see you to get to that point of saying, okay, before I go out and look at any homes, I want to make sure I am pre-approved, that if I decide I'm going to make a decision, it's almost as if it's a cash deal because I've already been approved. How long does that usually take?
Well, it's very quick because, part of the reason, of course, is that in a lot of cases, we have to get an appraisal. That can take a week, 10 days. And we usually try to get the loan underwritten subject to the appraisal anyway, even if there is a property identified. But in a case where you're trying to get underwritten and formally approved by a lender before you've even found the home you're going to make an offer on, we set it up with the property address to be determined. We will usually put in a county and a city with the zip code, so we have a general idea where the property is likely going to be located. And then we can, gather up the documentation we need for the loan file, register it with the lender, and submit it very quickly. In fact, we could probably, in most cases, we can take a new application to getting a formal underwriting approval, I would say max 15 days or less. What that does for the buyer is it gives you more leverage. The biggest complaint I hear from buyers is if they find a property that is desirable and has multiple offers, oftentimes they're competing with somebody who's going cash. And if you got to get a loan, particularly, maybe you're putting a minimal down payment, 5, 10, 15%, you don't look as good as that cash offer, even if that cash offer might be slightly lower, but it's, pitching it's all cash and we can close in 10 days or 15 days. Some sellers will go for that and give up maybe a few bucks in terms of the higher price from the buyer who needs a loan and maybe a big loan with a low down payment. Well, at least this way you can demonstrate, we provide a copy of the approval from the lender. Here is the formal written approval. Here are the conditions. They're all escrow, title related, and property related. Appraisal is what that means. And this buyer is good to go. So it gives you a better standing when you're being compared to other, what would be considered maybe stronger offers, either because a much larger down payment or a cash deal.
Before we go into this next topic, I just want to hit you right on a couple of things you said. Is inflation? It's actually I had on the chart there. We had on the chart there is 2.39. That's actually down from the last. I think it was 2.88. And so to me, it's like, okay, that's closer to our target than further away. The job market situation is better as far as new jobs created, and the stability that you're talking about, like you said, hey, the rate has been the same for the last almost 12 months, if not more than 12 months. It's like, what are we waiting on?
Right. Well, exactly right. And I've said on the show here the last several weeks, the major agencies, Fannie, Freddie, their forecast for mortgage rates is we're going to be, now they've tweaked it a little bit. It was originally when we first, got into January of this year, both agencies said we're going to be at like high sixes, basically 6 5/8, 6 3/4 range by the end of 25. Now they've tweaked that to now more like 6 1/4, 6 3/8, but still in the sixes. And again, we've been in that range, as I pointed out earlier. You go back the last year, we've been in the high 6, low 6, briefly dipped into under 6 in September, but that was like for a week. And otherwise, it's been in this pretty narrow range. So, that's why it's just that shouldn't be something that should be holding somebody back at this point, especially when you consider that the forecasts are still in the sixes this year, probably still in the sixes next year. You're right. Interest rates should, in my way of thinking, interest rates should no longer really be the reason somebody's not wanting to buy. There's got to be other factors at play, because this is going to be our interest rate landscape, I think, for probably the next couple of years.
Well, and I think something else, and this is, if you're watching us now, a couple of episodes ago, you talked about the affordability index. Do you mind just kind of giving us a brief overview about that as well? Because I think people are thinking, I can't afford the housing market is unaffordable, but this index, which is an independent study, has been going on for a long time, had something a little different to say. Do you remember, or can you share that information?
Yeah, the way that index worked is, and again, it's a mortgage interest rate affordability index. What it tries to do is bring some perspective to possible home buyers and borrowers about mortgage rates and their affordability from a historical standpoint. So what this model does is it takes and looks back 50 years to determine what was the average mortgage rate, for a conventional Fannie Mae, Freddie Mac conforming loan. What was the average interest rate over the last 50 years? Well, it turns out the number is about 7.74. which is, you know, 1% higher than where we're at right now. In fact, a couple of weeks ago, it was almost 1.5% higher than where we were. So 7.74, that's the average over 50 years. So then the idea is you take that and then look at what the current mortgage rate is. And there's a math calculation that then occurs where you divide one into the other to come up with this ratio. And if the result is 100, then that means that the current mortgage affordability for the current rate is equal to what it has been historically, the 7.74. Well, where we're at now, when we're talking in the 6.25, 6 3/8, 6.5 range, like today, 6.5, when you do that calculation, that ratio results in something like 1.2. That's when you're that strongly above 100 with what the current rate is. That is a strong signal that the current interest rate available to prospective home buyers is, historically speaking, very affordable compared to the historical norm. So that's the perspective. Now, I understand the real world of, well, okay, that all sounds great. Some mathematicians, came up with this formula to tell us we should be happy about where rates are at right now. I mean, I know I can hear somebody thinking that because, we still have to make the payment every month. But what it does is it should adjust your perspective to realize things aren't as bad as, again, the headlines make you believe. Yes, are we double what rates were in 20 and 21? Absolutely. But 20 and 21, we keep talking about it. That was once in 100 years, not going to happen anytime soon, if ever. We have to, and it's so funny how that still has grabbed so many people's mindset. You got to let it go. Current rates are, historically speaking, actually quite good, as I just explained with that ratio. So embrace it, and we can help you figure out how best to take advantage of the current conditions, including rates, and get you into an affordable situation.
Well, thanks for doing that. I appreciate that. That was a little off script there, but I thought that was important to kind of bring things back into it. So I'd like to shift gears a little bit now when you talk about inflation, because you said interest rates do not like inflation. And quite honestly, when I was preparing for today and getting the slides up, and I was going to the 10-year, I was kind of wincing because I thought, with all this going on, it's got to be higher than it was last week. And I was so pleasantly surprised to see that on a downward yield track that it was fun to take a look at that. But let's talk about that. It says, we've seen inflation tick down to 2.39. How does that shift affect long-term mortgage rates, and should buyers be optimistic right now?
Well, first I'll say yes, they should be optimistic. Now, in terms of the backdrop here, in terms of the inflation rate level and long-term rates, mortgage rates, what's the interaction there? What's the correlation there? First thing to understand is inflation, especially higher inflation, that's the enemy of bonds. And of course, bonds are essentially fixed rate, fixed yield investments. And so when you own that kind of asset, you don't want to see higher inflation, because given that that asset is providing a fixed yield, well, in an inflationary environment, that higher inflation level diminishes the value of that interest yield on your fixed asset, and it pushes down the value of that bond. So I know that's all kind of technical, but understand that most mortgages serve as collateral for bonds. FHA, VA, USDA, they're collateral for Ginnie Mae securities. Those are Ginnie Mae mortgage-backed bonds, mortgages that are secure, that are insured or guaranteed by the government. And then, of course, there's MBS, mortgage-backed securities. Those are the kind of bonds sold that are collateralized by conventional loans, mostly Fannie Mae, Freddie Mac. So the basic idea, again, these are fixed yield assets. So when you have a situation where inflation is rising, it diminishes the value of those bonds, and that's what's going to push mortgage rates up. So you want to understand that that's the relationship, and that's why it's so important that as we get closer and closer to the Fed's inflation target, that should be, barring other factors, that should be helpful in getting rates lower than where they're at now. So we want to get to that 2%. The sooner the better.
Well, it's interesting that when you opened today, you were talking about Chairman Powell, and he was kind of forecasting higher inflation, yet it doesn't have so far in the I think in like in the last 2 or 3 months, it doesn't show that that's the pattern that we're seeing. Now, I understand the whole tariff thing is going on, but again, it's something that in negotiation, these are just sleight of hands that actually haven't caused anything to actually happen yet. As of my wife saying the eggs have actually ggone down.
Right.
Why would he say that? What's driving him to say that?
Well, I'll briefly comment on that, and then I think we can go on, because I think everything I could read on the financial news and saw on the financial show, like CNBC, there's this political aspect being suggested that Powell is not supportive of the current administration's tariff strategy, and for whatever reason he felt compelled to make a speech and basically, in so many words, declare that by suggesting that, hey, this strategy, if it bears out, is going to cause higher inflation and it's going to dampen our economy. So there, all the talking heads are like, getting paid to talk about why did he say that? What's his real true intention there? I don't know. I don't want to really get into all that, but it's obviously a situation that he believes may occur. But what I would want to underscore to everyone is, well, it hasn't occurred yet. Inflation came down in the last number just last week. Jobs were much higher than forecast 2 weeks ago. So the bad economy, the higher rates, hasn't happened yet. Could it happen? Yes, of course. If Powell's right and the current administration's wrong. But in the meantime, it hasn't happened. And that's why I say good timing. If you want to buy a home, get in now in case the worst part that Powell's predicting does happen. Get the home now. So
I agree. I wasn't trying to corner you into political conversation. I was just curious, if all the numbers are good, it's like, hey, you should start wearing a coat because winter is coming and it's 4 months away. How about we just wait, enjoy the summer?
That's a great analogy, because that's exactly what's going on. We're all being told to put on a coat in April, almost May of 2025 for, the wintertime in, December. And I tell you what, I don't want to wear this coat through August here where we're at. We're not going to do that. But
not a chance.
But I think that's a good analogy for what's going on with the media and the financial markets. Everyone is like scared of the shadow of what might happen with this whole tariff, process. And so as a consequence, everybody's on edge, and there's all these expectations, wild ones all over the map. And it's just got everybody wound up and stressed out. And we need to see how it all plays out.
All right. Well, let's see. Let's talk about credit scores and home buying mistakes. One of the most common questions out there: what credit score do buyers need to qualify for the best rates today?
Good question. And of course, it varies depending on loan type. The standard, kind of mortgage product we talk about all the time, of course, is that conforming conventional loan. In Riverside County, the maximum is 806,500. These are loans that generally are going to get sold to Fannie Mae or Freddie Mac. Those two agencies have a credit score grid that is published that determines how a mortgage is going to be what I call priced, which basically means what effect on the price, the rate, and the discount cost, if any, is going to be applied toward that loan based on credit score. So their grid is in tiers, 20-point tiers. So the top tier is 780. So if you're going to get a conventional conforming Fannie Mae Freddie Mac loan, you want to be 780 or better on your score. That will get you the best rate. Now, again, keep in mind, when we say 780, if it's one borrower, that's their middle score of the three bureaus, Equifax, Experian, TransUnion. If it's two people or a married couple, It's the lowest middle of the two people. Um, so that is how, the score that's used for getting the best rate. Now, what happens is, as I said, the Fannie Freddie grid goes down in 20-point increments. So your second best tier is 760 to 779. Then your third best tier is 740 to 759. And your fourth best, 720 to 739 and so forth, all the way down to 620. So, and when you get further down on that schedule, down to 620 to 639, the adjustment or the hit to the price of the loan is pretty hard. It's going to probably mean you're going to look at a rate that's going to be somewhere in the range of probably at least a half to maybe as much as 0.75% higher than if you're at 780.
Oh.
Now, in FHA, VA, USDA, I would say generally you're going to get the best price or best rate if you're in the 720 to 740 or better. So you don't have to be as high as 780 to get the best rate. The other thing about those three agencies, again, those are direct federal agencies where they insure or guarantee the loan. The tiers for lower scores are much wider, much, I say, kinder or much friendlier. So you don't have as much of a price hit, as we call it, for a borrower who isn't at 740. If they're at 610, they're going to pay a higher rate, but the extent of that higher rate is much more muted than if it's a conventional loan. That's why I always say, if you're going to put 5% down on a conventional loan, or you've been told to do that, and your credit score is 628, I will urge you darn well better be looking at an FHA option as well, because what you're going to find is you're going to be much better off on rate and therefore payment if you're on that lower credit score level to go with an FHA loan. Do not go with a conventional loan. You're going to be paying a lot more in terms of monthly payment. So that's, and then on jumbos, finally, I'll comment on those real quickly. For a jumbo loan, again, same thing. You basically, for best rate, in some cases, you have to be as high as 800 or higher. Most are going to be somewhere in the 760 or 780 plus. And with jumbo loans, you don't get to go nearly as deep down on the credit score range. Most jumbo programs kind of stop or aren't available if you get below, say, 660. Then at that point, jumbo loans get pretty hard to find.
And jumbo loans are just simply above the allowable. What you tell me? What a jumbo loan is? An amount that you're borrowing above a certain amount.
Yeah, the jumbo loans, broadly speaking, is any loan amount that's higher than the conforming conventional limit each year. So the national conforming conventional limit is 806,500. Now, in some areas, what we call high cost areas, typically by county, there is a secondary category called agency high balance, where you can get, not in Riverside County, we don't have an agency high balance because of our price level. But in LA County or Orange County or San Diego County or up in Northern California, if you're in Santa Clara County, you're going to have a second category for Fannie Mae Freddie Mac loans called agency high balance that will go even higher. So the point is, a traditional jumbo loan in Riverside County is going to be any loan that's 806,501. That's a jumbo loan. Whereas in Orange County, the traditional official jumbo loan would be $1 over the agency high balance limit, which is like somewhere around $1.1 million or $2 million. So that's basically the difference between jumbo and then conventional or FHA VA.
We have one question that came in from one of our viewers that I want to share. It says, there's a lot of advice floating around, like, don't buy a car, don't open a new credit card while buying a home. Can you confirm what's true and what's just mortgage myth?
Actually, that's not a myth. That's generally true. I mean, the idea here is that, and this is true whether you're refinancing a home that you already own or you're looking to buy and you're opening an escrow, we do urge people, try to be careful about incurring new debt. One of the things folks don't realize, and they've, in a few cases, they've found out the hard way. When we start the process and we pre-qualify, of course, part of what we're going to do is pull your credit. Well, some folks may think that when we do that, okay, it's over. They've got my credit report. I don't need to worry about anything, and I can just do what I please. I'm going to go shop for a car this weekend, and yeah, I don't think it's none of their business. I'm just going to go do it. Well, that's a problem because especially if, again, we've got an open escrow on a purchase, or we've started a refi, we open an escrow for that. The loan's in process. It's registered with the lender. It's going to be underwritten. The lender is going to continue what we call basically credit backup monitoring. So throughout the open period of processing either that refinance loan or that purchase loan, up until it's closed and funded, the lender is going to be in the background monitoring your credit. So if you apply for a new credit card, you're out shopping this weekend and 6 different car dealerships are pulled your credit, they're going to know, and we're going to get contacted, and we're going to have to, find out why that occurred, find out if you open a new loan, and get documentation for that new loan, and then we have to determine if that's going to affect your otherwise, you've been pre-approved perhaps, find out if that's going to affect your ability to qualify once we discover that new debt that wasn't disclosed.
So then the answer is, hey, once you start that refinance or a purchase, just kind of put things on chill until after the loan is closed.
Basically, yes, but if you feel compelled that you have to make a purchase decision of some sort, maybe a major one, a lot of times it has to do with, I want to go buy appliances because it's this weekend only, some sale for the house I'm in escrow to buy. Can I go buy those appliances because we haven't closed yet? Best thing to do, check with us if we're handling your loan, check with whoever is handling your loan, find out what you intend to do, let them know, and they can crunch some numbers and tell you if you should or if you should hold off.
One other piece to this is there a difference if I were going to go, let's say, buy a car versus, oh, I'm going to lease a car? Does that show up any differently, Art?
No, no. In fact, a car loan payment or a car lease payment have the same effect on your qualifying debt ratio. The one thing I would tell anybody who already has a car financed, and if you're looking to apply for a loan, one benefit of owning a car with a car loan versus leasing. If your car loan at the time you've applied for a mortgage, based on the monthly payment for that car loan, is going to be paid off in 10 months or less, we can ignore that car loan payment in qualifying and calculating your debt ratio. If you have a car lease and your car lease balance is 9 months to go based on your lease payment, we still have to count it. And the reason is with the lease, if you think about it, logical, it's a lease. What you're paying doesn't, at the end of the lease term, doesn't mean you've paid enough to outright own the car. So you will have to either turn in the car, which means you'll probably have to get another car and incur a new payment. Or if you want to keep the car, not have a payment, you'd have to find funds elsewhere and pay off the lease balance, the residual value balance, so you own it outright. So for those reasons, even if you only have 2, 3, 6, 7, 8 months to go on a car lease, we still have to count it.
Makes sense. Well, in our final topic here is we have a couple there renting versus buying with a baby on the way. Their concern is says a young couple is expecting a baby and thinking about buying a home instead of continuing to rent. How can they figure out if now's the right time financially?
Well, actually, the most obvious thing to do, and this may sound self-serving, but call us and we'll get you pre-qualified. And part of that process, I mean, seriously though, part of that process exactly hits on this kind of, these kind of questions. Our role in pre-qualifying somebody to buy a home, we dig into some details, obviously, about your financial profile. We learn a lot about what you earn and how much money you have in the bank. And a good part of that process is us being able to tell them, a young couple in this situation, number one, what can they afford? What can they be relatively well assured we can arrange a loan for them at a certain price level and so forth? That is going to be very helpful to the family to know that information very specifically so that they're comfortable feeling like it's an okay time for them to buy. Now, part of that process, unfortunately, sometimes is we have to be the ones that say, no, you're not in a good position. I know you got a young baby coming, but here's what, and then what the role we play there is try to get them on a path where they can qualify, in a reasonably quick fashion at a later date. So we get into a situation where we go through a pre-qual process, and in a case where we determine we can't get them to where they want to go with homeownership right away, then what we try to do is determine what needs to change in order for them to get there, and give them some real good ideas about how to do that.
Well, I've noticed just here in the Coachella Valley, and I traveled over to Arizona, and I see the same thing. A tremendous number of multifamily houses, apartments are being put together. And my niece, who lives in Arizona, when she said she was moving, I just casually asked, well, what is the rent? And when she told me, I was just absolutely flabbergasted, because she's going to have to rent with two other people. And she's an architect, so she does really well. But the cost of renting. So I'd look at this and say, is there an easy or a simple way for someone to calculate, hey, if they're better off continuing to rent, or if buying is actually more affordable and stable, especially, with a family on the way? And the reason I ask is, we don't look at things like the write-off for taxes or depreciation or whatever it may be, that's something you can help with, to help them understand, hey, I'm better off, instead of just giving my money to the landlord every month, I should be buying.
Well, exactly right. In fact, you hit on a couple of very good points. Number one is a lot of folks um, who are renting, and I think they should know, I mean, they're paying rent themselves, is like, but a lot of folks maybe who aren't even renting and they're still living at home, uh, is, rents are pretty high. And I think in a lot of cases, people who are renting and paying those very high rents don't have a real handle on how much that rent payment they're making, how far that would go in terms of having a mortgage where they could own instead of rent for that payment. Now, I'm not going to say that a majority of homes out there listed for sale, even with a modest down payment, are going to have a monthly payment as low as what you're paying in rent. But the gap between the two is, in a lot of cases, not as wide as people think. So that's number one, is to raise that awareness. And then number two, during that process of us pre-qualifying you, in most cases, yes, the total housing expense for ownership, the mortgage that we would arrange, the taxes, the insurance, the HOA dues, that total monthly, probably a majority of cases, is going to be more than what they're paying for rent right now. But again, the gap in a lot of cases is not that wide. And then what we do is try to show them, hey, look, you're paying a little bit more per month than you're paying now. That may feel uncomfortable, but you have to take into account, for example, the tax benefit of home ownership. We can help you. In fact, we can even get you with an accountant where they can, in very great detail, show you, what you would do in terms of adjusting your withholding from your paycheck to bring more cash home every month to support that higher housing expense, recognizing the fact that you're going to get a tax deduction benefit from the mortgage interest at the end of the year. A good accountant can calculate that very precisely. Here's how much more money you can bring home to cover that little bit higher housing expense. And by doing that, you're not going to get a big refund at the end of the year, but you're not going to have to pay either. So there are tricks you can do there, and we can help a prospective buyer with that, so they can recognize that little bit more per month is going to be worth it when they consider the full picture, including the tax deduction benefits of home ownership.
Do you think there's this is my last question. I'll let you go for today. One question I think of is, when I was younger, buying my first home, it was really kind of a starter home. It wasn't my dream home,
Right.
but it was my way to get my foot in the door. You're dealing with people every day. Is that mentality still alive, or is it more like, no, this is my first home, but I want it to be my dream, my forever home, or I have a certain level that must be there? And is that holding people back from making a decision to buy a home?
Well, I would say kind of. What I would say to that is, yeah, I mean, I don't see a whole lot of folks who are buying a home when they're relatively young and thinking, yeah, this is it. This is, I'm going to be one and done. This is my, forever home, like you said. Now, of course, keep in mind, what do we know? We've talked about on the show here in the past weeks. I think the average age of a first-time home buyer now is like 38 years old. Now, what I think that does maybe has created a little bit is maybe that first-time home buyer who is 38 might be a little bit more picky about what they want in their first, home. than maybe in past generations where, I got my first home with my high school buddy and his parents, and it was 58 grand. And, in 1979, and it's like, it was a starter home. I mean, this thing was not a palace. But, I think so. I think there's a little bit of that at play, where the first time home buyer, being of a higher age in general, are going to be a little more picky about what they buy as their first home. But I don't think it's to the point where that home they're going to buy is their last one. They are still going to move up, albeit probably a little bit later in life.
Well, Art, thank you so much for covering this array of topics. I thought it was really good with the fact that we have, the inflation talk, the tariffs, the interest rates. I thought, well, why don't we just give you a plethora or a buffet of topics? And I really appreciate you going through this. Sure. Art, I'll turn it back over to you, but I've got your number on there. If you have information or questions with Art, or you want to get pre-qualified, or you have questions about this, 760-969-5023. With that, Art, I'll turn it over to you. Thank you.
All right. Thank you, Jeff. I want to thank all of you for watching and listening to this week's Mortgage Minute. Hope you have a great holiday weekend. Good Friday tomorrow, Easter Sunday, of course, coming up. And, of course, if you're here in town in the Coachella Valley, upcoming is your second weekend for the Coachella Fest, and then we got Stagecoach coming in next week. So I hope you all have a great holiday weekend, and we'll see you next week on the next edition of the Mortgage Minute. So long. Take care.